Hello traders, Damien here, coming to you to make this little Q&A video. I like to do more of these, so I will scan through the thread, and when I come across a question like this that I think needs to be expanded and talked about in greater detail, I will pull it out and make a video, as I think that these videos add a unique perspective into what may be happening in the market, and also add some valuable insight for you to develop your skills further. So Brand, we'll call you Brand, and if I butchered your name, I'm sorry, says he pulled the trigger on one more pair, yen pair, still hoping for an unstoppable train downward. Okay, Brand, I think that it's important for us as traders to not, and I'm not singling you out, this is a common mistake or a common thing that I see among traders and in the thread, is that we're still trading on hope. Okay, and you know the saying, if you trade on hope, you go broke. Okay, we are empowered traders, and that it is important for us to understand what may be happening and why certain things happen. So we're going to take this chart here and we're going to tear it down. But first, let's look into the question at hand. Mr. Pip, in this screenshot, if you look at the number of bars in the rectangle, it's more than 60-hour bars. Does it mean that the order flow expectation of a new structure low is not valid? The answer to that question is no. That is the expectation at hand. Has the expectation weakened? Yes, but it has not failed, and because of that, it is still the expectation. How does the time duration come into the picture while deciding any order flow? Okay, so the question is, how does the time duration come into the picture while deciding on any order flow? It really isn't. There really isn't a duration to keep in mind. The most important thing to think about is, what kind of a trader are you? Are you an intraday trader? Are you a swing trader? Are you a position trader? What kind of a trader are you? And that is the time interval that you need to look at. Now, regardless of what interval you look at, whether it's tick, range, whatever, you're always going to find some degree of consolidation or congestion as price action develops. You know, some areas are stronger than others, and the forces of B are fighting it out, and sometimes it takes a while for imbalance to take place, okay? Because the market does not move when it's in balance, okay? So when you see consolidation, when you see an area of congestion, that's the market getting into balance, okay? But the market also seeks imbalance, because that's how price moves from area to area, right? As a byproduct of imbalance. One side has to overpower the other, or else price cannot move anywhere. So rest assured that as price gets balance, also pressure is building, and imbalance will sooner or later take place. Now, I would also tell you that that imbalance usually occurs on the side of the expectation, meaning the expectation usually plays out. So because of that, we always need to align ourselves with the expectation, okay? So the time duration between a new structure high and new structure low and the new structure high and new structure low are not important. They really are not that important. Now, the longer price stays within a main swing tells you what? Somebody's getting weaker, somebody may be getting stronger, okay? So we definitely don't want or like to see that price stays an extended amount of time in an area of a correction, okay? Because that, it means that the sellers in this particular case here are doing a fair amount of wasting of money, right? The money that's coming in to sell. We'll dissect that further when we get into the chart. So although in this case, since price retraced almost 100%, I am not looking for a clean new structure low, more like a 61 through 78% retest. I think you should very well still expect a new structure low, because that is the expectation. Until that fails, that is the only expectation you should hold on to. Now, could you say that you would expect price to come back down and maybe the buyers try to defend those levels? That's a very real and reasonable expectation, right? But the expectation is still for the market to make a new structure low, Okay, but there's other clues here that are going to lead you towards some other conclusions, and we're going to get into that picture now. So I hope I answered your questions as they were asked, but I also want to dissect this chart and dissect the order flow. Okay, one of the issues that you have here is that this is a cross. This is not one of the majors, and these crosses are not traded very heavily by the masses, which means that they tend to be a little more erratic when it comes to the price action. They tend to be more volatile because there's usually, it's easier to create imbalance because less money, less people trading it. Imbalance can take over on not that much money at times, depending on what's going on in the liquidity and stuff. But these cross pairs are more dangerous to trade because of those reasons, right? And because of that, you can also expect these swings to be quite large and add to a unfavorable risk reward overall. When you look at this chart, you see that price has made a high up here, has made a weak low. We don't know what's behind that. We don't care. Okay, and then price came up here and made another low. Okay, a new structure low, and then price came up and made a new structure high, right? And then price has made a complex correction here and then made a new structure low. Okay, so we see that there's good momentum on both sides, which kind of confirms to you that it is unusual to see strong momentum back and forth on both sides. That tells you that the market is probably thin, probably not a lot of people trading it, and that very little money can cause the market to move like that. Okay, and then the market comes down here, makes another new structure low, followed by another proper correction, right? And then another new structure low, followed by a deep correction, retests, new structure high, new structure low. Okay, so you've seen in this sequence of swings here how many times the expectation has not held as a whole, right? But you also see that you see a lot of violence on both sides of the money, buying and selling, which tells you that this is probably one of those pairs that not a lot of people are trading, that it takes very little money to create imbalance and make price move sharply. Okay, but the question is when price gets stuck at these lows here like this, does it weaken the expectation? Should you not expect the expectation to play out? How do I process this? This is a 60-minute chart, and for an extremely long amount of time we've had price stay in this area. In other words, price has entered into a range, a very tight range that has been extended. This means that the market is balanced. Okay, there's a balance between buying and selling taking place here. Okay, that's what that means. It does not mean that you would expect the expectation to not play out, or that you should not expect the expectation to fail. Okay, but what you can see here is that there is a balanced market, which means a lot of buyers are coming in, and so are a lot of sellers coming in. Now, the term "a lot" I use loosely because it's a cross, so we don't know exactly how many, but we also have a lot of evidence here of what? Price action breakdown, right? We have a lot of expectation failures. We also have very choppy price action, very deep corrections, weak projections. Momentum is strong on both sides, so we have a near regularly market strength here. It's fluctuating back and forth. A lot of things are playing out. Also, a lot of things are failing. All these things lead us to what? An erratic market with price action breakdown, where both sides are wanting to take price in their intended direction, but nobody's really winning overall except for the sellers. Now, why? Because they've spent a little more money. Okay, now what's happening here is the same thing that we saw, not the same thing, but one of the things that we saw in today's live stream, where we have a range, right? We have a couple of tests here, a couple of tests here, And you need to ask yourself what's happening and who's winning this battle and what would I expect. Well, one, we had an expectation failure here of a new structure high. We also had an expectation failure of a new structure low, back to back. Failure, all within the same swing. That tells me that I should expect the market to be range bound, as there is some confusion as to who is in control here. Okay, that range bound price action now needs to speak to us and say, well, what is the expectation? A new structure low. Who's winning the immediate battles here? And we see that price came here, right? Price came up, price tried to come down, the buyers came in to defend these lows, and price made a new high. Okay, that's a win for the buyers. Okay, then the sellers came in to attack. We had a retest of this area, and price has not been able to really make another win here, but also the sellers tried to attack early and got even less for it, and then price moved up here. Okay, this is a significant win that price was telling us already. In this area right here, we see buyers tried to come in, the sellers won. Then the buyers produced one candle, sellers, what happened? Then price made a lower high here, right? But in the immediate order flow, the sellers did attack, and what happened? The buyers came in to defend, and we made a new high here. Okay, now this is not a new structural high, but within this range, we know that what? The buyers are in control. What is the immediate expectation of this range? Is for price to break to the upside. That's the last thing that was accomplished. Now you can make the argument that this is a new structure low, whatever, but when you take, if you ask 100 people, is this a new structure low or is this a retest of this area? You know, probably 80% will tell you that that is a retest of the area, okay? So you need to really qualify what a new structure low or new structure high means to you from a qualification standpoint. So when you look at it, it can be 100% objective and not is this time or is that time or whatever, you know? This is a retest of the area. We did have a clear high here, and the expectation of this range is to break to the upside. Now that does not mean that the expectation is going to fail. That means that if price does break above this, okay, where am I interested to sell? Where are the sellers? Well, then you have to come up here and see that in this area right here, you know, this is the lower part of your rectangle, this is the upper part of the rectangle. That's the area that I will be looking to engage. You know, one, because we've had severe breakdown of price action to the downside. Okay, secondly, we have a balanced market here at these lows, okay, and the imbalance, the immediate imbalance is favoring the buyers. All of these things should push you towards a deep correction. Okay, the deep correction, after you ask yourself, okay, where are the sellers? And you can see the sellers that really move price were in here. Okay, it wouldn't be here. The sellers that move prices here, like they came in here, they got something. They came in here, they got something. They came in here and they got something. So that is your area of interest, which offers tremendous risk reward into the expectation. Now, is this likely an expectation that is likely to fail? I think that there's a very strong possibility that that expectation can fail. But because this is a cross and because the price action has been erratic, this can be anybody's game, and the expectations for a new structure low, okay, and that tends to play out more than it doesn't. And on a pair like this, where you've had multiple expectations failures, one thing that you do see consistently is that the expectations have a tendency to play out more than they don't. Okay, so that tells you that you should look for good risk reward. That tells you that you need to be decisive in the areas that have moved price and not be too concerned about taking a trade where the risk reward is not there and where you see minimal engagement that produce nothing. Okay, the stronger decisions are being made here, and that's where they're likely to be made again. As you can see, the price shot up very good to this area and immediately found a nice response, and the buyers tried to come in again and they got taken, and they tried to come in again and it looks like they got taken again. So it looks like the sellers are serious about defending these highs, and at the very least you'd expect price to come down into this area here, offering you a possible break-even situation, or maybe getting aggressive and taking profits, since this area seems to be very strongly defended by the buyers. Okay, whatever your trade management rules say, that's what you should do. Okay, but it's important to understand that just because the market does this does not mean that your expectation is any weaker or less weak, but you do have to understand what that could possibly mean in order to position yourself okay, into the market, into a trade with the right risk reward and having the information that you can use to help you identify a better area of interest. So I hope that answered your questions. I hope that this little quick lesson had value. I think it's really important for the technical analysts to look at these markets and just look beyond the candles and look at what the market is working towards. Look at who's achieving what. You can always use the confluence of the short-term immediate order flow to help you understand, what kind of a correction are you likely to get. What is your expectation overall? What are you looking to trade? What do you want out of your trade? What are you trading? What is the scope of your trade? Are you trading the immediate order flow? Are you trading, a short with the expectation of a new structure low? But just because the market does this doesn't mean you need to abandon that expectation. That expectation is there until it fails. Okay, and once it fails, if you're in a trade and you still have an opportunity to get out, well, then you find a reason to get out, either a graceful exit or a rescue mission of some kind. Those are the questions that will probably weigh more heavily in your decision making as you're already on the pain train and you're deciding whether you should take out more risk. Sometimes that risk turns into a huge reward. Okay, why? Because the expectation has not failed, and because of that, I hold price accountable to that expectation until it fails. Okay, so there's not much more to say. Just be diligent about, okay, I'm looking to get short. I'm here right now. Price has done this. This is the information that I have. Okay, I see weak new structure lows. I see deep corrections overall on all these swings. I see price having a lot of complex corrections. This is a market where the order flow on both sides is breaking down. It goes through fluctuations of strength and weakness on the selling side to the buying side. We have a number of expectation failures. What does this mean? Well, it can only mean one of a few things. One, it's a thin market, right? There's not a lot of money trading it, which creates erratic price action. And that's kind of probably a better indication, since we have good momentum on both sides, and back-to-back good momentum tells me that this is just a thin market. It's a cross pair. It's not one of the majors. Adds more problems to the equation. These pairs, because it's a cross, because it's not one of the majors, is going to have a higher spread. The spread is going to fluctuate a lot more than on the other pairs. So this is just a bad instrument to trade. Does it offer great opportunity? Yes, but it also offers a huge amount of risk, right? Because volatility is a double-edged sword. If you're on the right side of it, congratulations, you're making a lot of money. You're on the wrong side of it, and it's quite painful. Okay, so don't force yourself to perform in an unfavorable market, in an unfavorable situation, because the market looks like it has nice swings where you can make a lot of money on. It's not about having nice swings where you can make a lot of money on. It's about being consistently profitable. It's about making good decisions with the price action that you have, and not get whipsawed around because it's a thin market that offers an illusion of, extended profits, or whatever you want to call it. Okay, I rather choose the slower, safer, more consistent instrument that I can read better, as opposed to wondering when the other side is going to drop $10 and make a deep correction. As a figure of speech. So that's my take on this. That's how I process this. We did that this morning on the live stream. We had the same expectation of the range breaking to the upside. However, that failed, and the market very quickly accelerated to the downside. That happens, okay? But it's important to have those basic expectations and let price do its thing. And as that is happening, then you will be in a better position to readjust your analysis, to amend your analysis, or to just say, I don't know what I was seeing, it was just plain wrong. And that's usually not going to be the case. By staying ahead of price, by understanding what the market's expectation is, by understanding who's winning those short-term battles, can help you understand where strength is coming in or where strength is leaving the market, and that's important for you to know. But under no circumstances can that information lead you to not following your trade plan. It may lead you to be more patient, find a better area of entry that's consistent with what you're seeing, okay? But it should in no way have you filtering out trades, because you do that once, not a big deal. But when you're consistently trying to filter out trades that are in your trade plan because you see what you see on the chart, that's an even bigger problem. That's going to have very, very bad outcomes when it comes to your profitability and your expectancy. Okay, I hope this video had value to you. I enjoyed this topic. I think it was important for us to address that. So why this is happening, why is the price action look like this? It's a cross, meaning not very heavily traded, creating more of a balanced situation, requiring more money to create imbalance. We also learned that it takes imbalance of money to make the market move, and when the market is not moving, it's because it is balanced, and the market seeks imbalance because that's how price moves from area to area. Okay, and just because price is in range, meaning a balanced market, does not mean that we do not have an insight as to who may win that battle. Okay, because we can see who's achieving what in the shorter term, and that allows us to see who's going to win moving forward. We had a little expectation here, new structure high, then we have price come down here, and then we see that the sellers tried to come in here, they didn't win. Then price moved up, sellers tried to come in, they got even less for it. Then price tried to come up, the sellers tried to come in, they got nothing for it. They were just consistently on the micro scale losing more and more ground, and when price came down here where the buyers had defended more strongly, look here, 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 look across, boom, the buyers came in, very easily got up to there. Because why? The money that was here defending these sellers, what? They ran out of money. And that is the tipping point, the imbalanced scale. Once you run out of money, you have no money to defend, so you go to the next level. Okay, super important to be able to spot that. Okay, guys, well, thank you very much, and I'll find another Q&A video to make here soon.